Hello, I'm Alex Davies, a founder of Wealth Club, and with me today is John Glencross, Chief Executive of Calculus Capital.
Alex, good morning.
Perhaps you could just start off by telling me a little bit about Calculus Capital.
Well, Calculus was founded almost 20 years ago. I was one of the co-founders. We've always invested development and scale-up capital in growth companies. We launched the UK's first approved EIS fund in 1999. Since that time, we've launched 17 further EIS funds. We also have a VCT. We have always invested, I think, in the spirit of legislation, which is becoming quite important. And we have a very, very strong track record of successful exits and have won several awards as well.
And you've got, as you say, a VCT and an EIS. Are they broadly the same other than the tax reliefs?
Well, they will both invest in the same universe of companies. VCTs have a broader portfolio. They are a different structure, as we know. I think the appropriateness of each, because they both are doing development and scale-up capital, EIS and VCTs, the appropriateness of each is really dependent upon the situation of the investor, what's best for the investor. EIS essentially delivers its returns through tax-free growth. VCTs generally seek to deliver their returns through regular tax-free dividends. So, and they have different tax benefits attached to each. So the universe that we invest in will be the same. There's quite an overlap between the two. Obviously the VCT is broader. And really then it's what's best for the investor in terms of whether it should be EIS or VCT.
And what sort of companies are you typically looking to invest in? What are the characteristics?
Well, we are generalist investors. Having said that, there are themes, and there are themes which change with the times, with the economy. Healthcare is something that we are quite active in. Environmental services is becoming increasingly important. Services to do with monitoring the environment and various aspects of modern life. Leisure is another area, and also technology-enabled businesses, which is not necessarily meaning that we're trying to push to new frontiers in technology, but it's using technology to provide services better. For example, we have a company called Key, which does the back office processing for financial services firms. That's a fairly traditional activity. Key has it very automated, which means that they provide it in a much more cost-effective and actually faster way than processes hitherto. So technology-enabled businesses. So we are generalists. There are themes. Those are areas in which we are quite active at the moment.
Any particular investments you've made recently that you'd like to talk about?
Well, yes. I mean, we are very active. We've invested in I think 8 new company investments in the last 12 months. One that I think is very interesting is Axol Bioscience. Axol was founded by a young scientist, relatively young scientist from Cambridge, interestingly born in mainland China, who had the idea of providing cell lines to the big pharmaceutical companies and the research institutes in order for their research purposes. And he took the idea to Jonathan Milner, Jonathan Milner was the founder of Abcam, which is probably the most successful startup of the last 20 years, now worth several billion pounds. And together they founded Axol, and Axol provides cell lines to pharmaceutical companies, to research institutes, for research purposes. The important thing when you're providing that is consistency in terms of those cells from one time to another, because if you are doing research, your results are going to be very dependent upon the consistency of what you are doing your research using. So I think that's a very interesting company, very interesting to have brought together a young scientist, entrepreneur, together with a very experienced individual, Jonathan Milner, who is also recently voted NED of the Year for 2017. So that's a very interesting company in which we've just invested about £2.5 million, both in our EIS and our VCTs. Another one is Cornerstone Investments, which is an online retail play, which is growing very strongly, providing toiletries mainly to the male market, which is one of the biggest growing markets, where we've invested just over £2 million as well. So, and then another one, which is very interesting again, I think, is we have co-invested with Arm Holdings in a company called Blue Wireless, which is developing the technology for a new generation of microchips, which will be used in what's in 5G and in WiGig. And WiGig is essentially what comes after Wi-Fi in terms of rapid, short distance transmission of high volumes of data. And their model is essentially the ARM model of licensing their technology to users around the world. So I think it's very interesting that we partnered with a very experienced, very large technology company in Blue Wireless. I think those are all very interesting, quite different, each quite different, but very interesting investments.
So it's pretty diverse, but are there any types of companies you would avoid?
Well, gosh, that's a very interesting question. I think you need two things. You need several things for a successful company. You need to have a robust business plan, you need to have a clear market need, and you need to have good management. Without the three of those being present, you're going to struggle. I think one of the areas we generally have not done what you would call the asset-backed type investments, and I think the reason we've not done that is that we've always been growth investment. We've always been development and scale-up capital for growth companies. We've never really been proficient in what you call the asset-backed capital preservation. That's not been the area we've pursued. I think that actually is becoming more under scrutiny by many people in terms of whether it accords with the spirit of the legislation. So I'm pleased to say that I think in 20 years we have always successfully acted in accordance with the spirit of the legislation.
Mm-hmm. And of course the rules changed in 2015 at the same time, which made VCTs, EIS more restricted, where they can invest at the same time. Lots of pension restrictions mean loads and loads of money coming into these types of products. Are you finding it harder to get deals?
No, I think it's interesting. As I said, we've been in the market, we've been investing following the same policy for almost 20 years. We have very established deal flows. When you've been in the market that long, when you've been investing that long, and you have a reputation, as we do, for being sensible people in terms of doing a deal, reasonable in terms of recognizing it has to work for all parties, and in terms of being very good, well, I hope we are, very good partners after we've invested, because you have to remember you spend several months making an investment, you spend 4 years or more partnering with those companies. So we have a very good reputation in the market. We have those sources that we have worked with throughout who will come to us with an opportunity because they know that we will deal with it efficiently, sensibly and professionally. We each have our own network. So I think it also management's a very good source, and managements will introduce other managements, but also we are going the second and third time round with some management teams in terms of backing them, and our investors. Our investors are on the whole a very financially astute and literate group, and quite often we get very interesting opportunities referred by them. Yeah. So I think the rule changes have been painful for some. We've all had to adjust, but I think we probably, because of where we were in the market and the fact that we were very established in the market, have been able to have maybe had one of the easiest adjustments to the new rules.
And the wall of money going into it isn't pushing up prices for you?
There are areas of technology at the moment. There's fintech and to an extent edtech, which I feel are getting very overheated, where if your management team comes in, they have somewhat elevated views of their valuations at a relatively early stage. We would avoid those because in-cost is clearly relevant to returns, and there are plenty of other areas where we can invest very successfully. And I mean, if there are other people who want to be drawn into those areas, well, that's fine. But I think we'd all be very mindful, and be as part of our experience over 20 years, very mindful about not being drawn into what we would consider to be areas that were overheated or where it had become a little too fashionable to be investing.
Okay. And the proof of the pudding, especially with EIS at least, is exits, and you've had a good number of exits. And
we have a very strong record of successful exits. We had a very interesting company called Human Race that did a lot of sports in the community. For example, they organised the London Winter Run. They did a number of very high-profile triathlons. We sold that very successfully to a company. If I said it's called ASO, people would say, well, who is that? If I said they are the owners of the Tour de France, or as they insist on being called in the documentation in reference to that, Le Tour de France, that was, I think, a very successful exit to a very high-profile company that was a very good fit, very sensible in terms of developing that business. And that was a trade sale. And another exit, very different, is Horizon Discovery, a company that provides services, again, to the pharmaceutical and the research sectors, both in part a technology company and part a bioscience company. We were investors as that company moved from being a private company to being in a public company and quoted on the AIM market. We supported it through that process, and we exited after it had IPO'd on AIM, and our returns were in the region of 2 times.
Okay, now finally, if I'm going to invest in an EIS or VCT for that matter this tax year, why should I choose you?
Well, that's a very good question. I think we have been doing what we do for a very long time. We believe we have very robust methodologies in terms of making our investments. We do very intensive due diligence. We have a program of working very strongly with our companies after we've invested, because that is very important. It is not just about making investments, it's not just about exits, it's about working closely with these companies to develop them and mitigate risk. I think the thing that I would say is, I think we are relatively unique, possibly unique in the market, in having a very high level of repeat investors. Investors who have come back, not twice, but several times over the years. And I think the fact that if your clients believe what you're doing, or believe in what you're doing, such that they do come back many times, I think that's probably the best guide to that we are doing what we're doing well, that we're doing it well, and we're doing it well for our clients. So I think that's probably the thing that I would point to.
John Glencross of Calculus Capital, thank you very much.
Thank you.